Welcome to part 2 of Options 101, Terminology and Basic Concepts, brought to you by TradeRightly.com. In part 1, we defined what an option is and the underlying asset that it controls. In part 2, we are going to talk about why does anybody trade options? What is the point? Well, the answer to that question could easily take up an entire course of its own, so I'm only going to give you a few examples to think about. The first is profit. If I have the right to buy Apple stock because I bought myself an option, and it gives me the right to buy Apple stock at $390 per share, and Apple is currently trading at $400 a share, you can see there's an obvious profit incentive there. I can exercise my option and buy it for $390 and immediately sell it for $400 at a profit of $10 per share. Obviously, it's not quite that simple. I'm not taking into account transaction costs, how much the option cost me, but it's only important for us to get the concepts of these things down. So just stick with my simple math for now. While we talk about why people would actually be trading options. The other use that's not quite so obvious is for insurance purposes. And let's say I actually owned Apple stock. I am an Apple stock owner. I'm in it for the long haul. I believe Apple stock's going to keep going up, and I've got a ton of shares. Let's say that I paid $400 per share for that stock. Now, let's say I have that, I have an option here. Up here I gave the example if I had the option that gave me a right to buy. If I have an option which gives me the right to sell Apple stock for $390 per share, you can see I've reversed the math that I gave you in the first example. And so there's no profit incentive here. If I bought it for $400, why would I want to sell it for $390? So that doesn't make a whole lot of sense. But what happens if Apple tanked and fell all the way to $380? I can still sell my stock for $390 per share, which effectively cuts my losses in half. So I know that those examples probably generate a bunch of questions in your mind, but it's only important that you realize there are numerous purposes and strategies that incorporate options trading, most of which we are not interested in. Something that is relevant to our use of options is the concept of leverage. Leverage, in the case of options, simply means that you can control stock without actually owning it. Leverage allows a smaller amount of money to do the work of a larger amount. As an example, let's say I have $2,000 to invest. An option to buy 100 shares of Apple anytime within the next month costs $2,000. So I can buy that option that allows me to control 100 shares of stock. And I can choose to purchase that stock or not. Now, to actually own 100 shares of Apple stock, let's say it's currently trading at $500, that costs us $50,000. So the relatively low cost of an option as compared to having the cost incurred by purchasing the stock outright, that is what allows us to make money in the market without having huge sums of capital to invest. If you have $50,000 to invest, more power to you, that's great. But for those of us with smaller bankrolls, at least because we want to start out slow and small and conservative, this gives us the ability to play in the market. In other words, you don't already have to be rich to make tons of cash by trading options. Now, you and I trade options because it gives us consistent and uncommon, and by uncommon I mean huge profits, with a manageable known risk. That is, we know upfront the maximum amount at risk, and we have several strategies that help us reduce potential losses if a trade doesn't go our way. Stick with me, Grasshopper, and I will teach you the secrets, at least those that I know. Now, to partly explain why our options trading profits are consistent, we need to look at what market conditions are like when we make money. Now, the only way to make money by buying stock is to sell it after the market has gone up. The market has to go up. You know, the old buy low, sell high. But at any given point in time, there are three things that the market can do. It can go up, it can go down, but over relatively short periods of time, it doesn't do much at all and just goes sideways. Because we can trade options that control the underlying at prices either above or below the current market price, we don't really care what the market does. We don't have to be fortune tellers. We make money in the best of bull markets and the worst of bear markets. And that's it for this episode of Options 101. For more information on how you can beat the pants off the market, visit TradeRightly.com.